Leggett Platt, it is an amazing company. Now, with the current dividend yield over 10%, I have to ask, is this an amazing opportunity that we should be seizing with both hands, or is this a value trap that we should be running away from as fast as we can? Now, in today's video, I'm going to try and answer that question. I'm going to be looking at some of the business fundamentals, some of the key metrics, as well as recent business decisions. We're going to look at what's going on with the company, some of the challenges that they face, how it relates to those key business decisions, and we're going to be looking at whether or not the dividend is safe and whether or not I think this is going to be a buy. I'll also let you in on some of those key metrics that I do look at, as well as those metrics and some of the trends I'll be watching very closely in the next couple of years. So let's get into it now. Now, this is not a stock that I've had a position in a while now. When I was researching the video, I wasn't quite sure where to start, but here, if we focus on this, they have a commitment to enhancing lives with better quality products and empowering and rewarding careers and doing their part in bringing about a better future. They're constantly evolving new industries and expanding the industries that they're currently in. And they're really about comfort here. So comfort solutions. Now, they talk about some segments, really, homes and offices and everywhere in between. And we can get a sense here of the business as we go through this. Bedding products, spring specialty foam, adjustable beds, specialized products, high-performance automotive comfort and convenience systems, tubing, ducting, fabricated assemblies, as well as flooring, furniture and textile products, so more complex, sophisticated seating. It's a business that has some challenges in a highly inflationary environment. They are selling, if you're thinking about bedding, they're going to be selling primarily to retail. They're looking at consumer sales. They're going to be looking at when consumers want to make these purchases. Now, for many consumers, when we're thinking about high inflation environments, this bedding product is going to be a high ticket item, and the question's always going to be, at least from my perspective, why would we buy the bed now? Why not wait? If prices are high and money is tough, I would wait. I would be inclined to put off the purchase for a large item like this, which may be seen as more of a luxury. Now, some of these specialized products and could also, I think they face some fairly strong competition in the marketplace also for these products. So when we begin to think about the inflationary environment, I think this is a company which is facing a little bit of difficulty here. But I'm going to use several different investing platforms to try and dig into what's going on here and what this means for the company. First off, turning into fast graphs. So I've got Leggett Platt pulled up here. Set here always for me for the adjusted operating earnings as my first area that I'd like to look at. Now, as we can see here, from about 2008 to 2018, earnings increased, and they increased quite strongly. So we're talking about, as well, price-to-earnings ratios from 10.47. We're talking about EPS from 86 cents through to $2.57. So we're talking about strong growth for 10 years. I think we can give them a bit of a pass during the post-pandemic difficulties with earnings, but this is what I am not happy about seeing as a potential investor here, is a dramatic drop here in the earnings per share in 2022 and 2023, with further warnings that the earnings per share are going to drive lower in 2024. Now, the company itself, at this level, is paying out a 10.42% dividend yield, which on the face of it, it looks good. Now, one of the big questions is, would this dividend be cut? Is this dividend safe? And that's a question that we're going to try and answer today. But on the face of it, this is not a trajectory. It's not a direction that I'd want to see a company's earnings per share going. Now, if we scroll through to a few other elements here as well, just visually, The sales here map out in a way which is trending upwards to the right, which is what I want to see, although analysts are expecting a couple of years of very flat sales going virtually nowhere. And so it doesn't look like a company that's going from strength to strength in sales either. Operating cash flow has been strong over those 10 years, and since 2018 has been weakening off, although it's not been too bad post-pandemic. EBITDA, again, we can see this is dropping off, not as badly as the adjusted operating earnings have dropped off, but we can still see the EBITDA values have decreased quite substantially. Now, if we begin to put the dividend on here as well, now this is one of the difficulties here. The dividends are not being met by increasing earnings, and we can see that as a dividend king they have a track record of increasing this dividend. So adjusted operating earnings do not cover the dividend. The operating cash flow appears to cover the dividend, and when we just begin to look at this, it's certainly something where I think it's trending into an area, a time where this company could have difficulty potentially covering this dividend. The question is, as we look at this in more detail, is this still going to be a valid set of assumptions? Now, if I put price on the chart as well, we can see that price has generally followed. Normal PE line on as well. Price has generally followed the earnings per share quite closely, and you can see how prices have fallen and have repeatedly fallen down here. It seems to be trading at a very reasonable level here of about 13.3 and a blended price to earnings ratio with a good dividend yield. Is this the right time to pick it up? And that's really what we're looking for here. So if prices are going sideways, it would suggest that if earnings are going sideways here in the next several years, as analysts might anticipate, if earnings follow this trajectory, they could go further down, or they could head up a little bit. It doesn't look as though we're going to have a lot of price appreciation over several years in this company. Let's have a little more of a look at what's going on in the company. It is a 2.3 billion market cap, so quite a small company, BBB- credit rated by S&P, a 51% debt capital ratio. Now I want to flick over in fast graphs on this premium subscription here, and I just want to have a quick look at some of these other elements here in the health check. Now, when we begin to look at the margins, we can see here that they are lower than the sub-industry averages here, and we can see this here where they are listed in green and the sub-industry here is listed in black, and we can see the more visual representation of the difference in this top chart. We can see that they have lagged, and they have been lagging. There's no big surprise here. Operating margin, so again, it's neck and neck in the last couple of years. It's been weaker than the sub-industry average. Net margins, it's been a bit weaker in recent years and slightly stronger in 2023, although this is not that they've performed particularly well, it's just that the rest of the sub-industry has performed even worse. Return on assets. And we can begin to see here that the return on assets is a little bit higher than the sub-industry over recent years. Return on equity has been stronger in recent years in general. Asset turnover has been better than their peers. And the long-term debt capital, I'm pleased to see this is better than their peers in general. They've had more debt, than their peers. So they've had more long-term debt to capital than their peers have had. The recent change here from about 2022 to 2023, they have not really changed, but the sub-industry levels of debt look like they have climbed quite dramatically, probably in response to recovering from the pandemic. Is the dividend safe? Now this is where, if we begin to look at the dividend safety, the last couple of years, this is the free cash flow to equity per share of 2.8 and the dividends per share of about 182. And the answer is it's not as compelling a margin of safety as I would have expected to see. And we can see the operating cash flow hasn't been growing very greatly. One thing that is good is, even though they had done a good job from about 2008 to 2018 in reducing the share counts through share buybacks, it's good to see that they haven't really been engaging in this activity in recent years, and I think when I was looking through the earnings transcript, this is not on the agenda either at this point. Return on assets is more or less following the same sub-industry levels. Return on equity following the same sub-industry levels, and so we're talking about some decreasing returns here, and return on invested capital also seems to be trending in an adverse level here. So what does all this mean? It seems to be a company that is having some challenges, some pressures at the moment. By itself, it doesn't seem to be in, for example, a sort of a terminal decline, but this is certainly a case where they seem to be having some challenges. We're going to jump in, have a look at what some of those challenges are next. And the dividend, on the face of it, with a very fast look here, appears to be under pressure, but might be safe. So let's have a look at some other details here on a few other platforms and see what else we can learn. Okay, I am on the Koifin platform now. This is a wonderful platform which draws a lot of data together and making it very easy to have a look at what's going on with the X-ray vision almost. I'm here on the cash flow tab for Leggett and Platt. Now, as I scroll through, what I really wanted to quickly flick over here for and look at was the dividends. So this is a company which is paying out about $240 million of dividends. Now, the big issue here is this going to be covered by the free cash flow? And the answer is yes. So they appear to have adequate free cash flow to pay these dividends. That is good. This is positive. Now, as we look at the slides for the fourth quarter 2023 conference call, we can see their 2024 guidance is for dividends of about $245 million. If we flick back to Koifin, we can see that would still be covered by the free cash flow. It appears that they've got sufficient free cash flow. The free cash flow itself has been more or less moving in a way that it doesn't look as though they would be in any substantial danger at this point in time. It does look, for example, a free cash flow drop to levels of 2017, 2018, they would struggle to cover the dividend. Now, it is of course possible that they could use debt to cover the dividend. This is a possible outcome if times became very tough or we had higher levels of inflation for longer. Is that a good thing? And the answer is, in my mind, as a potential investor, no, I would not like to see them use debt to cover the dividend payments. However, this is a dividend king. They have been raising this dividend for such a long period of time that the question becomes, would it be reasonable for them to use debt for a short period of time to pay the dividend? The answer is probably yes. Now, if I was advising the management team, I would say, if at all possible, increase the dividends in 2024, maintain that dividend king status. But I wouldn't be looking for an increase in the dividend level which would match what we've seen in the past. So if you look at past annualized dividend growth rates of about 4 to 5%, it's been fairly consistent. I would expect in 2024 that we see a very small, nominal, or a token increase in the dividends. I think that would be the smart play for Leggett & Platt, leaving as much cash as possible to manage some of the other situations. Now, the dividend yield here is now at such a high level, it exceeds the level that it was in the global financial crisis. Is this a value trap, or is this an amazing opportunity? The answer is, it is always going to be hard to tell, but this is essentially why the dividend yield has been skyrocketing. Since about 2021, once we had a better fix and understanding of what was going to happen economically post-pandemic, we've seen this price dropping. Now, as a consequence, with the strength of that dividend, it has pushed this dividend yield to quite a high value. Now, if you also begin to look at the percentile rank figures here, this looks like an absolute steal. we're talking about some amazing valuations here against Leggett Platt's 10-year history. We're talking about some really good opportunities, it looks like here, but at the same time we also can see against their own 10-year history, they're also performing at a very weak level, as we can see here from the margins and profitability perspective. Again, the leverage that they have is higher than it has been for them in the last 10 years. Now, it's also important, though, when we begin to look at comparable sub-industries here across the United States and Canada, the leverage is about ballpark, the margins are about ballpark, so they're just not performing as strongly as they have in the past. With the analyst price targets, I would often expect to see an analyst price target here in black to be higher than the prices on the market, and that's what we saw in early mid-2021. Since that time, we've seen analysts, I think, being fairly realistic, and we've seen prices tracking analyst estimates fairly closely. Now, overall, we're seeing a more negative picture here. 5 analysts covering the stock, 4 on a hold, 1 on a strong sell. So it looks like analysts are somewhat challenged by this company and the current situation. If we go through to the transcripts from the last earnings call, we see that while they're still expecting the end of 2023 to be weak, they are focused on maintaining the investment grade credit rating, which they have, just managing debt leverage, which they are doing adequately, and also maintaining their dividend track record. Now, that doesn't necessarily mean market-beating dividend increases in 2024, but it does look like it means that they are very much intending to increase dividends, maintain the dividend king status, but not much more. Here we're talking about increase in dividends, but again, not very much, so very minimal levels of dividend increases here. One of the challenges that I think they've had is bedding. Now, I'm going to switch gears here. We're going to go and have a little bit of a historical look as well at Leggett Platt, what they've been doing over the last 10 years, and perhaps get an understanding of how this is affecting the company. Okay, so 2018, they acquired Elite Comfort Solutions for $1.25 billion. Now remember, this is a relatively small company, so this was a reasonably sized acquisition for the company. And I think this first bullet point is a key point. If you want to understand the logic and the rationale here, they wanted to be the differentiated leader in the bedding industry. Now that sounds good. Now, this gives them access to specialty foam technologies, and they wanted to leverage the R&D capabilities, particularly in Elite Comfort Solutions. The big challenge is, how well has this gone for the company? And the answer is, it's been barely adequate. Now, in some ways, when you think about this, 2018, a couple of years before the pandemic, you could almost argue this is bad timing, but that's tough because bad timing affects all people, and managers do have to plan for bad timing as well. But I do want to have a look at this bedding segment for the company. So we're going to switch over. I'm going to pull up some details for the KPIs for Leggett Platt. Now, the Business Quant platform enables you to access details around some of the key performance indicators for particular companies. Now, the platform uses a range of analysts, and they basically extract and create a database about these KPIs from earnings filings. And so from this, we can see here, at this point in time in 2020, they basically shifted how and what they measured in terms of the product types. But we can see here, bedding became important. Now, if you think about the importance here of the acquisition, bedding grew very strongly up into 2021, and then we've seen from that, the bedding segment has been incredibly weak. But we've also seen some weakness here also in furniture, flooring, and textile products as well. And so we can begin to see that the specialized products, they have been growing or staying steady. So if you think about these more industrially focused products, they've been doing well, but it's been this consumer side here, particularly the bedding, a very discretionary purchase, and this is where I think Leggett and Platt have been hurting rather badly in the last couple of years. Now, with the focus on the acquisition of Elite Comfort Solutions, bedding should be a major part of what they're focusing their attention on, and the very fact that we've seen weakening sales in bedding is concerning even with the wider economic circumstances. Management apparently has a plan. Now, this is again the conference call for quarter 4 from early February, so a month and a half ago. And one of the key points here is they are going to be walking through some restructuring that they announced January 16 that would focus on the bedding product segment. They're going to better position the bedding business for the future. They're going to optimize bedding manufacturing and distribution footprint, so reducing the number of facilities, which should drive down some of the costs. And most of these actions will be taken within the US. It's also important to note here that they talk about it. This is basically what I've already noted, is there's the bedding market, mattress consumption levels are very low. Hence the bedding sales segments are down 14% year on year. And so we're talking about some very challenging issues here. So they're going to be trying to improve operating efficiencies and drive valuable product solutions. With Elite Comfort Solutions as part of their portfolio, they should be gaining benefits as a vertically integrated organization. So they should very much be able to grow this business. They should be able to maximize operating efficiencies. However, as I look down here, they talk about a refocused bedding strategy, key product growth, improved profitability, enhanced value for customers and shareholders. But I'm not seeing any meaningful talk about what exactly they're going to be doing, which is fairly, I think, standard for this type of analyst call. There's no real inclination to explain what approach they're going to take. There's no inclination to explain how they're going to unlock this value. Now, I teach operations and supply chain management in a university business school, and I can certainly say, given that they've had the acquisition completed for several years, they should be in a much better position in bedding. A lot of this work should have been done. Now, yes, there's been some substantial issues with the pandemic, but having said that, it looks like they had some low-hanging fruit here. It looks like they didn't have the opportunity to benefit from this before the pandemic, but if they're doing the right job now, they should be able to seize this opportunity. They should be able to maximize and benefit a lot from these efficiencies, and they should be able to begin to make that product available, meet more customer demand, and unlock more value for customers. Now, the big question here in my mind is going to be what's going to happen in the future. What is inflation looking like? What are these expectations looking like? If we are looking at a situation of higher for longer, then I would expect there to be continued weakness, particularly in the bedding segment, and that's going to continue to make their job difficult. With the difficulty and speed of supply chain turnarounds, I would expect this to take another 1 to 2 years before we begin to see the benefit of this, at which case we might also be in a better economic environment as well. What does that mean? I would say, ultimately, okay, I love dividends. I think ultimately we're going to see, recap, I think we're going to see some increased dividend payments. I don't think the dividend is in substantial danger unless the wider macroeconomic environment deteriorates substantially. If we buy now, we lock in a 10% dividend yield. They might need to use debt to pay dividend to get them through a rough patch as the economic conditions improve. The efforts that they're going to be making, particularly with that bedding segment, to really unlock more efficiencies in this segment, if this begins to turn around and shoehorns up, and we begin to see the economic recovery, and they're working on those efficiencies, we should see improved margins. We should see the margins rise above the sub-industry averages, and we should see the company in a very good position. I think I used the word should quite a few times there. And ultimately, that's how I see this. I see this as an opportunity here to lock in high dividend yield. I don't think it's going to grow very much for a couple of years. I think the company has quite a number of headwinds. The management team is going to have to do a lot of things right. They're going to have to take a few chances potentially. But it's also a company that isn't expected by analysts to be growing particularly strongly. And it's this weakness here in the operating earnings that makes me incredibly cautious. These adjusted earnings are not looking as though they're going to trend in the right direction. Now, sales, yes, we're trending in the right direction, but not the operating earnings. Now, for me, I'm seeing this as I would say, a very speculative buy. If you want to hold on, I think we could see some further downside here. But look, I think Dividend looks safe. The company looks like it's making the right noises. It looks like they're focusing attention on the bedding segment, where I think they've got the most opportunity to unlock the best value in their supply chain at present. It's their biggest segment. I think they've got some great opportunity here. Wrap this up. Is this a company that I will be investing my money in? And I don't have a clear answer to that. It's, in my mind, it's more of a speculative buy. I think it's a good opportunity. I think there's some good income there. Even if the company was to cut the dividend, for example, a 50% dividend cut would still give us a 5% dividend yield. And I do think we're going to see this company turn around in the next several years. And my question that I'll be trying to answer, looking through a couple of other opportunities, is simply whether or not there are other opportunities out there where I think I can deploy some of our family's funds to earn a safer or better return over time. I'm not looking at this where it's going to be a strong capital gain anytime soon. This is purely going to be a dividend play at the moment, and it's more speculative because the company basically has to turn around. So look, those are my thoughts, and I'm very keen to hear from anyone who holds Leggett Platt. It's a company which has zipped from the lows of low 20s up to the high mid-50s here, and now it's all the way down into the teens, down at about $17, $18. So it's been a roller coaster ride for shareholders of this company, I think, over the last several years. Let me know in the comments below, is this a stock that you have in your portfolio? What are your thoughts about where it's going, and are you going to be holding it or adding to your position at these levels of very elevated dividend yields? Let me know. I'm very keen to hear your thoughts. Let's get into it.